everybody. Welcome. You feeling the thaw yet? No?
Feels great.
Yeah, it's getting there, I heard. Well, I'm sure it's somewhere in the raw report. This date compares to last date in last year. So welcome everybody. Thank you. My name is Jamie. I'm the Chief Value Officer here, and I'm just up here representing the leadership team. And we do all we can to learn what your needs are and meet them. And again, serve agents, impact lives. That's our main thing. So we serve you. You are impactors, and we get to impact more people that way. And this is what we've been able to put together for the month. Just to recap, Jared was here for the first team meeting, and he taught us a lot. One of the things is we can set bigger goals, but if we don't change who we are inside, we're still going to fall short of those bigger goals. We have the ALC panel. We get to learn their heart and soul for their industry, for themselves, for each other, for the market center. And it was a beautiful thing, and we get to witness it quite often. And AI, we had Jason show us a deck of AI that to get us started, get us going, and it was genius. And what's even further genius is you get to follow up with him anytime you want. You got your own AI Al right here.
Call me out.
Call him out. And then Colin has come here, drove many kilometers. And so this is a big event every year is the economic update. See, he even sounds like Santa Claus. That's where he's from. He's that far north. And I didn't know this, but he's also sprinkling in a little Ken in the I mean, not a little Ken, sorry. Sprinkling in some Ken wisdom in it. Sorry, I said we'd never do that. No, it's a Freudian thing. Sorry. Next week, please come. Please come. We had the opportunity to meet this gentleman. I get really nervous when I hear the name Yvonne because I was really embarrassed on the baseball field by a guy named Yvonne Rodriguez, and I still have nightmares. So that kind of freaks me out. But I'm okay now. But he was so articulate in how to serve people in this time, and it was so lacking of judgment, and it was so lacking of politics. And it hit us as we're sitting there talking that we just need to hear more about how do we serve people right now, regardless. Right now, a lot of Minnesotans or various communities are carrying fear and uncertainty, and you may be too. So how can we show up best for people? And he'll help us with that. He's an absolutely beautiful soul. And speaking of beautiful souls, let's hear it for Brian. So we had the 10+ listings class, and Brian stayed after and basically did a class himself because the agents had a lot of questions about his systems, and you were just so giving him your time. And Olivia recommended a coach for you, and that has absolutely impacted your life, and we're just grateful for you. And also, daughter's team finished second this weekend, second in the tournament. So way to go, Brian. Anniversary. So moving forward, I learned something at the regional event from a fearless leader of ours, Olivia. Instead of lots of clapping at the end, just one big clap. All right. So we're gonna go when I go like this. Okay, you ready? Very good. She's a clap expert. That sounds even worse. Sorry, Olivia. Thank God she didn't hear it. Thank God she didn't hear it. All right, Steve Brawl, Gary and Michelle, Carol, Kim, Brian, John, Christy, Patty, and Tom. Let's give it up. Awesome. Now this is a crazy coincidence right here. That's amazing that you both happen to join the same day. That's outstanding. Top individual agent closed units. Jim Lee, Kristen, Pam, Tina, Tara, Nicole, Maria, Kate, Jennifer, and Chris. Way to go. There's something weird going on here, Pam. You guys are not disclosing something in these acts that aren't really. You all wind up like there. Like to know your secrets. Top team closed units. Kelly Arvidsson Homes, Quarantine Homes, CMS, Test Crew, Integrity Homes, Hauser Homes, Custodio, BA, Property, and Melissa Johnson. Woo!
You guys are faster than Rachel.
That's the leader up the front. And that's your job. Closed units. HHG, Michelle Hoagland Group, Steer and Root, Team Leisure, Janie Home Team, Cedar Haven, and Team Counters. Wonderful. Nice job, everybody. That's amazing. Profit share members, and this is the graphic that makes Grace cringe because I tried doing something in Gamma that didn't work, and we're going to go with it.
It's green for money.
If you don't like it, Grace actually did. The top profit share members this month, they had what's called anyway money. It dropped into their account anyway. They didn't know. Just happens. Didn't have to do anything else. Steve, Aubrey, Tasha, Jim Lee, Kim, Bryce, Cece, Scotty, Ryan, and Shannon. And CC, what do you got to say? CC, what do you got to say?
Yes, you mentioned a beautiful soul. Well, sitting right next to that beautiful soul is Rudy. We like to refer to her as Trisha Rude. Trisha is, as you know, an ALC member. She is constantly working on making sure that KWPR is growing. She brought a recruit to KWPR. She just walks the walk. She is Y4C23s all day, every day. So I just want to acknowledge her and let's all do it together. Trisha Root, everybody.
All right, well, I think that's what we'll do. Chant going from the movie Rudy Rude, but we figured it out. We gotta get the call. So, speaking of someone, let's have Tani come on up.
Yeah. You're slick.
Yeah, we are. Thank you. I have one short thing today, but it doesn't mean it's not important. We have contract to close coming on February 4th from 9 to 10:30 to do an orientation class here at KWPR. So if you have been interested in getting your transaction coordination services rolling, this is a great time to do that. You can come to the orientation. They're going to walk you through everything that you need to do to be able to get your transaction coordination services up and running. So she did send out an email recently to the brokerage with information and how to sign up. So if you're interested in that, feel free to look for that email, or if you have any additional questions, I can help you get signed up for that as well, too. Any questions on that? Perfect. Thank you.
Thank you, Toddy. All right, those of you who do not attend, you will continue to experience disorientation. Speaking of disorientation, where's Tom? Tom, come on up.
Thank you. That's a great intro. We're friendly table sponsor lunch today, and here's the hook. So we're gonna have a presentation during lunch from a little after 12 or so. We'll keep it short, but we're rolling out a new service. Now, we already do home inspections, commercial inspections, sewer inspections, radon testing, moisture intrusion testing, and mold testing. So what can we add that would even amplify any of that? You'll find out. And there's a special treat because you'll find some of your faces in our presentation. So if you want to see, come and check it out.
Nice. Tom. All right, everybody. All right. Let's bring on up the Rife group. Come on up, everybody, or whoever, or Ken.
We're gonna go start. Thank you. All right, we're gonna go quick on this one because we got Colin's amazing presentation today. It's gonna be great. So if you guys are available, and please, guys, if you can, grab phones. We've got the QR code. We're doing that mixer tomorrow, and there's really no motive to this other than let's just get together, hang out, have some drinks, relax. It's freaking cold outside. There's firm heat in this building that we're going to. If you need, it's really good. But yeah, we're gonna hang out. It's gonna bring a few market centers together. We just want to get together and hang, kick off the new year together, and we'll have some information about Agent Plus. But for the most part, this is just for us to get together and chill out, share some time. So that's all I'm going to talk about with Rev Group because we've got our thing today. But please, if we can move that up for like a minute, 30 seconds, that'd be great.
Sure.
Scan.
We'll also put it
Give-
back up.
Anyway, oh, perfect. Okay, and just if you can RSVP, and you can bring whoever you want. So, like I said, if you need multiple people, please show up and RSVP, just so we know how much food and everything to expect. So, okay. Thank you all.
Thank you very much. Hey, well, on one, here we go. Okay. Well, how about the man of the hour? The economist that we underestimate. By the way, Ken, I don't know what happened with that. You're like, you're always moving, so that's hard.
I
to
think
get-
it's just
all-
yeah.
Either that or you're a Sasquatch, you're always blurry. But,
I don't like it called Sasquatch. I don't know.
It's easy for us to take for granted the quality of the people, the quality of the knowledge and the depth and the heart and everything that we have here. And we have one of the greats in our midst, because that's what he told me to say on the sheet. Let's welcome up Colin, everybody.
I just noticed we don't have a whiteboard. Do we have a whiteboard still?
We do.
Okay, could somebody grab that?
Somebody will be me.
All right, we're gonna run through, this is gonna be very similar to what we've done in the past. Who's been here for this topic in the past? Okay, who is not? All right, we've got a few new starters. All right. We will run through this, like I said, relatively quickly. And the reason I want to do that is going to be repetitive for some, but I still want to hit on some of those main topics that we talked about in the past. And then, believe it or not, Ken's a pretty sharp dude, so I asked him if he could just say things in regards to everything that we're talking about. How does it actually tie into the finance piece of what we do? All right, we good with that?
Yes.
Okay. Same rules as usual. I'm gonna pace because that's what I do. And I'm going to expect that we have to wait communication. Right? Fair? Everybody in?
Fair.
Okay, good. Okay, what are we here to talk about? Number one, I want to talk a little bit about the Federal Reserve. What are they? Who are they? We're gonna see if we can figure out that mystery. What is inflation? Why is price inflation over the long term is a given? And then just some hacks and correlation between some of the I guess parameters that you hear in the news all the time or economic reporting, how some of those parameters tie directly to what we do, and just give you guys really basic information about how that matters. All right, knowing these few things are probably going to be ahead of 95%. Caveat, I am not an economist. This is all just stuff I picked up over time. It's very, very high level. It's very basic. So let's just run with it. Okay. All right. I left this in there. I think everybody, I made a joke last year. Everybody laughed at it. I don't remember what the joke was. So, but kind of cool fact, I think, about our currency, our money. Paper money, not really paper, it's 25% linen, 75% cotton. And you've got to bend it a lot of times, like 4,000 times before it'll break. Did you know that? If you were here last year, you should have. Okay, how do I make this play? Jason, you can help me with that? Okay, just pause it just for a second. This is still the best thing I've been able to find to really summarize our monetary system, and it's dated. The names you hear in here are dated, they're from past administrations. It's dated, but the concept is still the same, okay? So let's take just a couple of minutes, let's run through this, and then we're gonna start jumping in full force here, okay?
Reserve banking. The fraction of deposits the banks are required to hold in reserve is conveniently called the reserve requirement. The first way the Fed can change the money supply is by changing that requirement. Decreasing the reserve requirement will increase the money supply, and increasing the reserve requirement decreases the money supply. The Fed is the banker's bank, so if a commercial bank needs money, they can borrow from the Fed. The second thing the Fed can do to change the money supply is to change the interest rate that it charges banks. That interest rate is called the discount rate. Decreasing the discount rate will make it easier for banks to borrow, and that will increase the money supply. Increasing that rate will decrease the money supply. The third way to change the money supply is difficult because it requires Janet Yellen to get approval from the Illuminati, the secret cabal that runs the world. Nah, I'm just kidding. The third method is called open market operations. This is when the Federal Reserve buys or sells short-term government bonds. Now, government bond or something called a treasury bill is an IOU issued by the government that says, I'll pay you back later. Banks hold those bonds because they earn interest and are generally less risky than stocks. If the Fed buys these previously issued government bonds from banks, it increases that bank's liquidity and increases the money supply. If the Fed issues more bonds, the banks will have less liquidity and less money to loan out. That will decrease the money supply. In the US, deciding how many bonds to buy and sell is done by the Federal Open Market Committee.
Thanks, Thought Bubble. With these options at its disposal, the Fed can increase or decrease the money supply pretty darn quick. The option they use most often is open market operations. During the 2008 financial crisis, when the economy was in severe recession, the Fed went straight to work buying massive amounts of bonds, boosting the money supply and dropping interest rates to practically zero. But it wasn't enough. The economy was still in bad shape. So the Fed did something very uncommon in the history of central banks. It increased its monetary stimulus through something called quantitative easing. We call it QE at work because QE rolls off the tongue more easily than quantitative easing. Plus, who knows how to spell quantitative? Basically, it's when central banks buy up longer term assets from banks. So not only was the Fed buying regular treasury bills, it was also buying things like home loans, aka mortgage-backed securities. They did all this with made up money. This QE has raised worries about massive inflation. When you add a lot of made up money to the economy, prices can rise. Milton Friedman observed inflation is always and everywhere a monetary phenomenon. So if the Fed has been increasing the money supply steadily since 2008, why has the actual inflation rate stayed so low? Of course, as always, the answer is complicated. Many economists say it's because banks haven't loaned out the money. Remember, banks have to hold about 10% of their deposits in reserve. The other 90% is called excess reserves. Pretty straightforward, which is basically the amount that banks are free to loan out. Under normal conditions, banks would prefer not to hold a lot of excess reserves because holding money doesn't make money. But since 2008, excess reserves skyrocketed. This means that banks held the money and it never really got into the system. Why? Some say it's the stricter lending regulations, but also borrowing a bunch of money for a house seemed a lot scarier. Others suggest that low inflation in the US is the result of uncertainty in Europe, and that's caused foreigners to hold dollars. Some argue that it's because the economy is still sputtering. One thing's for sure, as the economy continues to pick up speed, we'll see the Fed clamping down on the money supply to increase interest rates. After all, it's the Fed's job to take away the punch bowl just as the party's getting started.
So now we've talked about the two main ways economists speed up or slow down the economy. Fiscal policy, which is changing government spending or taxes, and now monetary policy, which is changing the money supply. In an ideal world, the economy would always be perfect and we wouldn't need these tools. But the world isn't perfect, so sometimes intervention is necessary. So which one is better? Well, like any clear, unambiguous question in economics, the answer is it depends. It depends on the severity of the slump. Many economists argue that for your garden variety fluctuations, monetary policy is more effective. It's usually enacted quickly by experts whose only job is to focus on the state of the economy. But in a very severe downturn, fiscal policy might become much more effective. In 2008, the United States did both. It also depends on whether your country's central bank is tangled up in politics. The U.S. and many other developed nations work hard to isolate their central banks from politicians who might be short-sighted. The result is that monetary policy generally works and doesn't have a lot of side effects.
So the next time you see Janet Yellen in a magazine listed as one of the most influential people, you can shout, hey, I know who that is and I know what she does. The people in your dentist's office might freak out, but maybe not.
Maybe they watch Crash Course Economics.
Thanks for watching. We'll see you next week.
Thanks for watching Crash Course Economics. It was made with the help of all these nice people. Now,
All right, so fast forward 12 years. We did the same thing except on steroids, right? COVID, shut the economy down, and then we dump a bunch of money into the system to make sure the economy keeps going. Seems kind of counterintuitive. The other thing that I found interesting, they talked about all the money being dumped into the system, and we haven't seen resulting inflation. Well, fast forward 14 years, what did we see? All kinds of inflation. So I think maybe this video being dated is more valuable than I give it credit for, because we can look backward, see what they talked about, and then see what's happened since. So I find that a little bit interesting. Okay, so the Federal Reserve, we talked about the Federal Reserve in here. Somebody that was here last year should be able to answer this question. Federal Reserve, government entity or not?
No.
What kind of entity is it? You know who makes up the Federal Reserve?
Governor.
Yeah.
The
well,
lizard people.
That's state government, but they call themselves. Well, they act on behalf of, but there's no real clear cut answers.
Lizard people in the Illuminati.
What's that?
The lizard people in the Illuminati.
Yeah, for sure. So I think it's super important just to know like that distinction, right? This is not, they're not part of the federal government. This is a very convenient. What is inflation? What's inflation? Valuation of the dollar. Okay, and how is the dollar devalued? Okay, all right. Another thought? Any other thoughts on it? What is inflation?
Losing jobs and prices go up.
Okay.
It's more economic.
And that's the most common answer that we hear, right?
Colin, could you repeat some of the answers?
Prices going up. Okay. Right? That's one of the most common answers you hear. Price inflation is a result of monetary inflation, which was the first answer. Monetary inflation is just adding more money to the economy than can be currently absorbed. That's what it is. Okay. So let's talk, and they hit on it in that video, let's talk about why price inflation is a given. It's a guarantee over the long term. So we did this last time too. So we're going to start. All right, Ken's the Fed. All right, he's the guy with all the money, and I'm starting my new country, and I don't have any money, so I'm going to borrow money from Ken. All right, I'm going to borrow $100, and we talked, or they talked in that video, that it's basically I'll pay you back later, right? That's how the government operates. So we need $100 to run our new country. I'm going to get $100 from Ken. Ken says, no problem. Here's your $100. But I want a return on that. I want 3%. Okay. So now what do we have? Got $100 in my pocket, but I owe Ken $103. Now what do I do? Got $100 in my pocket, I owe Ken 103.
You're gonna find $3.
I gotta find $3. Ken, can I borrow $100 from you? Another $100? Sure. Ken says, great. Great. Now I've got my $3 to give back to Ken. Problem is, Ken still wants 3% on that next $100 that he gave me. Where are we at?
6% now.
Now I owe Ken 206. So I'm in a bit of a pickle here. So I'm gonna ask Ken for another $100, and he says, absolutely, let's do it, man. I like it. I like how you're running this country of yours, Colin. Nobody would ever say that. So you can see the problem, right? We can't run our households like this, so it is a totally foreign concept to us. It makes no sense, none whatsoever. but that's how the federal government runs their business. So we can see where the problem is, and we can see why, given the way our monetary system works, over time, price inflation is guaranteed. I'm gonna prove that to you a little bit later. Are we on the same page?
Yes.
Okay,
Doing great.
that's the key right there. That's the key to all of it. Because we're always hearing, well, waiting for prices to come down, whatever the case may be. And you know what, that may occur in the short term, but this guarantees that won't be the case in the long term. If this is not the case in the long term, everything's reset and we're paying with shiny rocks or something. Okay. Good
I'll
on that.
interject quick too. Just something to think about is like the tendency of the Federal Reserve and like the chair. They're never talking about, like, when you look at a press conference, have you ever seen them say we're wanting to completely eliminate inflation? Has that ever been stated? Like, can't. It's not like it'd be very difficult to complete, like, because that ain't mathing, right? So it's really all about controlled increase. And to your point, like, our economy is set up to where that is going to happen, and those correction points are what we call crashes, right? Generally speaking, you have those correction points, but like our long-term economic plan is with built-in inflation. It exists with, like, the parameters of our economy are set around the fact that we know that we're going to have increases. There's going to be slow injection of, you know, 30% adding in. Yeah, it's built that way. So people kind of panic, like, how is this tenable? The reality is it's a system built on knowing that you're going to have monetary shift and monetary change. Like, we're going to keep printing money. That's going to happen. The speed at which we do that is what we can control. GDP obviously helps to offset some of that, but we'll never have enough GDP or injection into our domestic product incoming to offset the 3%. That'd be very difficult to do. So,
And 3% is just an arbitrary
Yeah.
number, right? We know the Fed talks about a target of 2%. I'm sorry, nothing goes up 2%. We all know that. We've all been to the grocery store. It's not 2%. Okay, so what are the common terms that we hear? CPI, right? We're gonna have data about the CPI being released, and this is super important because it's a measure of how quickly is our prices inflating, right? That's our measure that the government uses. So consumer price index, it's just essentially a measure of average change over time of certain goods that the government measures. All right, so they're just comparing it from yesterday to today. Can you think on that, Jason? All right, so as of right now, all items through December, year over year, we're looking at about 2.7% increase. And everything up here is nothing more than some of the measurements that they use and how they vary, right, year to year. So we see some that go up more than others, some are down. Energy is down. We've seen that at the gas station, right? Fuel is costing less. So all this gets weighed into that CPI number. All right. So when you hear that, this is what they're talking about.
it's also important to note too that, like, you got to remember that the U.S. as a country, we are selling ourselves as a country to the global economy, right? So you'll go through phases where all you hear about is energy and gas, right? Do you ever feel that way? Like, all I'm hearing about is gas prices. Then the next phase is, man, all I'm hearing about is grocery store prices. And then the next, it's like, why do I care about manufacturing? What, I don't know. Like, why is that a number? We, based on that chart, like, we will determine things that we want to highlight as an economy to the global economy, right? So when gas prices are down, we want to sell that our energy costs are down. That's a good thing. Invest in US. Our global economy is doing really well. Don't look at that 1.8% increase in this sector. Let's focus on that sector. So it's, I think when we talked about it, it almost can sort of feel like a whack-a-mole a little bit. Like, you'll have certain sectors that are doing really well. So this is kind of a cool portion of the presentation where I tell people like, this is a really cool opportunity for you to know like, hey, I'm hearing a lot about how energy prices are down. Let's pull up that chart and see how the rest of the sectors are performing, because you can see this. I mean, it's data that's compiled. So.
Yep, absolutely. All right, another measurement that we use, PCE. So that's the personal consumption expenditure. Now, this is a little bit different because what they do with this number is they use this and they kind of track people's consumers' behavior. All right, so for example, like we've got up there, if beef gets too expensive, people are probably going to buy less beef and shift more to chicken. All right, I kind of chuckle at this because to me, the cost of something is the cost of something, and if it goes up X percent, it goes up X percent. What they're doing here is really tracking behavior. So this is weighted more on services than it is goods. 65% services, 35% goods. You're going to hear a little bit less about this. Usually it's PCI, but just so you know, this does come up, and this is what they're talking about. Now this is maybe a little tough to read. Headline PCE, 2.8% for an annual change. Headline is everything inclusive. Core PCE excludes food and energy. All right, both of those are pretty similar to one another, and I think a lot of that is due to fluctuation in energy costs. Questions on that one? Okay, PPI, Producer Price Index. So what this measures is the cost of a good in its first sale. All right. So probably the best example I could give you, timber comes out of the forest. We're not measuring the cost of the finished 2x4. It's that first sale of timber to the lumber yard, for instance. Okay. Can you click on this one, Jason? This is super overwhelming when you look and see what they actually track. It is unbelievable. We're not going to go through all this. Final demand is up 3%. So that measurement, 3%. I went through this. I saw the same thing last year. For all the smokers in here, tobacco just keeps jumping. It's like 7% this year. So another good reason to kick the habit. All right, let's jump back out of that one, Jason. Okay. All right. So I haven't really been following news a whole lot lately. So I don't know if the word recession has been in the news a lot or not, but it was for quite a while. So I think it's important to have an understanding of what a recession actually means technically, because our clients may bring it up, right? Hey, I'm worried about recession. I'm worried about recession. What is a recession? What does it really mean? So let's start with GDP. Ken touched on that already. GDP is essentially a measure of the economic output of a country. All right. Now, what's important to understand, it's the final sale. All right. So I used the timber to the lumber yard and to the finished 2x4 example. We're talking about the sale of the finished 2x4. We're not counting all the other business that's done along the way. GDP is the final sale of the product. Okay. Who can tell me what the definition of a recession is? Technical definition of a recession. If you were here last year, you could pull out your notes that I know you kept. And just double check.
I think it's, and I can't remember, 4 quarters of consecutive, not growth, but losses.
Yep, you're right on the right track.
It's either 2 or 4.
You have one number off, and it's 2.
Okay, yeah.
All right, it's 2 consecutive quarters of negative growth, so contraction. All right, it's very interesting. If you look at GDP reporting, we have 1 negative quarter, and then we had a positive quarter following it. I don't know if Ken has opinion has an opinion on this. I don't know how in the world we have not claimed a recession. Because all the typical indicators have been there. We'll talk about one in a second. They've all been there. I think it's the way things are being reported that has either, I'll just say, maybe been manipulated so that we don't have to use that R word and scare people. Heaven forbid we have scary words, right? Ken, I don't know if you have anything to add.
I mean, anytime, when I watch the news, every time they use the word correction, I'm like, okay, so we're in a recession. I think what it comes down to is the broad reporting of individual sectors. And my opinion is that we've been in one, right? You go to the grocery store today and, you know, I'm not kidding you, I went the other day and a 12-pack of Cokes are almost $10, right? Now, some of that's gonna be economic policy, some of that's gonna be how, you know, procurement and the PPI piece. Colin and I had I wouldn't say it was a heated debate, but we were kind of like, man, this PPI index is kind of stupid because who's in charge of the PPI? Do we just send in a government auditor and decide what a PPI number is, or is there multiple different corroborated accounts of, yep, okay, I agree with this number, yep, I agree with this number, yeah, I agree with this number. It's one source, right, for the PPI. You can, as a producer, manipulate the data as much as you want. From a recession perspective, I don't know how you could look at the economy over the last, you know, call it like a 10-year spread and say we haven't had a recession event at least once within there, right? So yeah, I mean, my opinion is we've had little mini ones, and
We're sector oriented.
We've definitely had sector oriented recessions. 100% we have, no question. But we've always just done just enough for there not to be that chart of overall GDP negative. It's like one sector just spikes. It's like, and I would argue that there is probably some federal intervention within that makes that sector spike so that they're not claiming that recession, because an economist can't come out and name that if the GDP number is there. So, but yeah, I feel like we've been there.
It's almost like a moving target. The goalposts are always moving. That's what it seems like. So let's talk a little bit about what one of the typical steadfast indicators for an upcoming recession is, and it's inversion of the yield curves. So yield curve, all right, so we've got treasuries, right? We saw that in the video. The US government sells treasuries, which are basically bonds, and it's an IOU. So we've got 3 month, 6 month, 12 month, 2 year, 5 year, 10 year, 30-year treasuries. So what we call the short end of the curve is like 2 years and fewer, and then the long end of the curve is over 2. So what we normally see is the longer the bond term, the higher return in terms of a percentage you're going to receive on your investment, right? The shorter end of the curve, the 3 month, 12 month, 2 year treasuries, generally you're going to get a lower return in terms of your interest rate. Now, when that flips, like we had for about a year and a half, probably a year, where the short term interest rates are actually higher than what the long term interest rates are, that normally indicates within 12 to 18 months, we will see a recession. It will be noted as recession. Didn't see the technical, yes, we are in a recession this time. That's why I scratched my head. It doesn't make sense. So, and actually, let me rephrase that because I left one piece out. When we go inverted, once we come back to the normal curve, it's 12 to 18 months is typical that we'll enter a recession. Okay. So these are things that we can watch and talk to our clients about, because you start talking about this, they're going to say, well, kind of seem to know what they're talking about. All right, questions on that? Do you want to actually click into that really quickly, Jason? If you go to Bloomberg on their site, they've got all kinds of interesting stuff. I go to this one pretty regularly. This just shows where we're at with some of the different treasuries and what they're paying out. So again, the short end, the 3, 6, 12 month, they're a little backwards, but they're not terrible. 367, 364, 351, and then you can see as we get to the 10-year, that's at 4.26, and the 30 years at 4.87. So that's more of a normal progression that we would expect to see. Questions on that? You doing okay so far?
Yep.
Okay. Skip a couple of slides here. Okay. Employment. That's another huge piece to the economy, right? What's happening with employment and how does that impact our economy? And that very well could have a pretty significant impact on GDP. Currently, 7.5 million people are actively searching for a job. There are 7.1 million unfilled positions. So that's just about 1-to-1 ratio. We're always going to have unemployment due to capability or choice, right? There will always be people that are not working, period. That's all there is to it. Right now, we're at about 4.4% unemployment rate. That's really good. That's really, really good. Everything I can find, 2-year projections have us in a range between 4.2 and 4.6% unemployment. I don't care who wins elections, who's in the White House, who's in the state capitol. I still maintain that our demographics are going to keep that unemployment percentage low for the foreseeable future because of those last 2 bullet points. Baby boomers. We've got 11,200 baby boomers turning 65 every single day. And of those, 5,900 are leaving the workforce every day. The reason it's not 1-for-1 is because they are trending towards working longer. All that does is delays the inevitable. So if we've got that many people leaving the workforce every day, that's awesome. Which is why I think that unemployment rate is going to stay in check for the foreseeable future. Questions, thoughts? Steve?
Possible to go back 10 years or so and see baby movers leaving the market. Comparison of one to the other in terms of a 10-year period, or
you probably could. Yeah, I didn't pull that up, but I'm sure you could find that information and look at it. Absolutely. Yep. All right. So let's go back to our video. Using the system. So what do we do if we want the economy to rock and roll? Essentially, we make money easy to get, we dump money into the economy, right? How many have heard I'm waiting for interest rates to fall? So what?
Never gonna see.
Well, my friend got 2.75. Well, my take on it is if we get to 2.75 again, something's going very, very, very wrong with that. Okay, we probably don't want that. So during COVID, just like the video talked about during the great housing recession in 2008 and on, we had the Fed, we had governments, everybody was dumping money into the system. What happened? Well, interest rates down. And what did they do starting in June of 2022? The Fed started getting aggressive, raising the short-term borrowing rates, and everything flip-flopped, and interest rates skyrocketed. Right? So we went from this to this. I think unjuicing is a word, but my presentation, so it is now. So what do? Jack the short-term rates. The Fed quit buying bonds behind the scenes, and all of this resulted in interest rates rising dramatically. Okay, what did we end up? We had low 8s for a while.
Yeah, we were at low 8s for a little while, very little while, but
Yeah,
we were there.
so that's pretty big. I mean, 5.5%, 6% jump. It's huge. So, what do we think is going to happen moving forward? Well, nobody knows for certain, but we do have correlations here too. So let's talk about that. All right, so the Fed funds rate, we hear about that. That's what the Fed adjusts, right? When they're increasing or decreasing rates, it's their Fed funds rate. The Fed fund rate tracks along with the 2-year treasury. You jump into that one, Jason. I think there's a link on that one. Okay. Can you go to scroll up if you would, please, Jason, and go to like 2-year. Okay, there's lots of lines on here, but it's super easy to follow. So the Fed funds rate is the light blue stair-stepped line. The green is the 2-year treasury. What do you see there? It follows. So the Fed is actually following the 2-year treasury in all these examples, or in this chart, excuse me. So that's our correlation. Whatever the 2-year treasury is doing, you can probably expect the Fed is going to get there at some point. They've been talking about holding steady. Look at where we're at. They're pretty much equal. Okay, so that's an indicator for what the Fed may do. All right, good correlation. Makes sense?
Yeah.
All right, let's jump out of that one, Jason. Thank you, sir. All right. The answer should be very obvious. What do 30-year fixed mortgage rates follow?
Good.
It's pretty much lockstep. Now, we see a gap between these two lines. Can anyone tell me what that gap is? What's that called?
Profit.
Other than.
Yeah.
That's what it is. Margin. It is margin. It's the spread. Okay. So why do they follow each other? Well, lenders look at the 10-year treasury and say, all right, this is kind of this is our safe haven number. If you think about how long do people usually stay in houses? 7 to 10 years. It's not a coincidence that mortgage rates follow what the 10-year treasury is doing. Okay, so that gap that we see is the premium or the spread, and that is the profit and covering uncertainty. All right, prepayments, defaults, all that kind of thing. That's where the lenders are making their money. So here's a chart of the spread over the last 55 years. You know what the gray lines are? The vertical gray lines?
Recession.
Yep, you got it. So those are recessions. What do you see during the recessions? For the most part. Spike. Why is there a spike? Uncertainty. Right, we're going to protect ourselves. This is since 2012, I believe. So it zooms in a little bit more recently. You can see exactly what happened during COVID. What happened after COVID? That spread absolutely plummeted. So historically speaking, we know the spread usually falls somewhere around 1.75 points, 1.75%. If you look at that chart, we got just shy of 3. It looks like we spiked over 3 for a very short period of time. So that's the 10-year treasury plus the spread gives us what our 30-year mortgage rates are. Okay, so when we were, if you'll remember, over the last couple of years when we talked about this, when we were up at 3% spread, what was the conversation? This is likely temporary. That spread will work its way out of the system, and rates will come down just because of the spread being so high, without the 10-year treasury even moving. I think there's two reasons that the spread got to where they are. Ken might agree, might disagree. Number one, uncertainty, or so they claim. I think number two, and the bigger reason, when those spreads were as low as they were during COVID, they weren't making much money. They're gonna make their money. They're gonna get it back. They're gonna get it back. So if you look right now, we're at about 1.8. That's where we're at on our spread currently. And that's gonna vary day by day, depending on what the treasury does and whatnot. So that's getting close to where it should be, right? Historically, that's really close to where it should be. So what has that done to 30-year fixed mortgage rates? Well, this goes back 30 years, or a little bit more than that, actually, 25, almost 50, back to 75. So again, I think it's interesting to look at what happens during recessions. And I think the overall trend is super important too, because having this perspective helps when we're sitting down and talking to our buyers, because again, everybody put their hands up saying, yeah, my buyers are talking about waiting until interest rates drop. Well, I don't know, if you look at the long term, you look at the big picture, doing too bad, right? I think there's a lot of recency bias. Yeah, my friend got 2.75%. Somebody just bought 3 years ago and they were at 4.75%. Well, that's it.
It was Jamie Diamond does these roundtable chats, and he brought this up, and I thought it was like a super cool insight into this too. Is and again, I'm not trying to pick on anybody here, but does anyone, when you were investing, let's say if you were investing in the mid to late 80s or early to mid 80s, how could you know how your funds were performing?
Maybe you gotta call the broker.
Call the broker, right? It's not, can't click into it, like I can go check right now if I'm up a penny or two. Like right now,
Well,
I
that's
can
all
know
you
that.
do. I saw your portfolio.
Yeah, it's bad.
That's all it's gonna be.
We're not in Canadian dollars.
Yeah.
Oh, Steve.
I think, not that many of us have been to a family reunion, but Gary Keller points out just about every year, when he got into real estate about 1983 or 4 or 5, look at where interest rates were. And I think he sold 6 houses his first month in business. And then he didn't sell anything. And because interest rates went, like 16, 17%.
18 and a half.
And-
4 buy down points.
Yeah.
First
And I
sale.
was trying to farm about 1976, and interest rates, I was borrowing money to operate, and interest rates to borrow money to farm went through the roof, and it destroyed me. So, yeah, so Gary Keller's been through the worst. And that's great that we have a leader like that has been through the worst, and he can guide us through just about anything.
And I'm glad you brought that up, Steve. Actually, Gary gets most of his stuff from this presentation. So, for those of you here,
He's on the call right
You
now.
can
He's watching us.
Yep, yeah, I'm gonna send the recording to him and he will take notes.
But I think that's an important thing, is like the historical data, and I tell that to clients all the time, right? Like, but we have to, with perspective, right? Like, we have to talk about what home prices are doing there. And then we have to talk about what home prices are doing here. And there is a very clear trend as to what direction we're going, and it's a downward push on rate, but it's probably an upward push price. So that goes back to inflation. That goes back to quite literally, like, we're not gonna eliminate it. It's going, prices are gonna continue rising, right? If there's anyone in this room that thinks in 20 years from now that a first time house is gonna be in the 300K range, that's not gonna happen. But going back to that point of like information being so readily available, our economic system, and he said, this is an opinion by Jamie Dimon, but this, I thought it was really good. Our economic system and the way that we operate works really well in a time delayed environment, meaning something happens, we give it a day to simmer, and then the market can react. Right now, like, there's entire, like, I've got friends that day trade. They literally play the game of in the moment market movement, right? And so our economic playbook is a little bit jumbled in that sense that you can make a trade in a half a second right now, and the markets react in the moment. And he said that it was just so much easier to guide clients when you had that day delay or that couple hour delay between a global event and, you know what I mean? So I think my projection is you're going to start seeing more times where the market shuts down early because they can control the stopping of trades or emotional trades. And when you start seeing more of those, he said that's when you need to start sounding the alarm bells, and we start seeing like, oh, the stock market closed early today. Why? What's going on? So I just think it's interesting to see that trend, and also knowing that in 20 years, depending on how quickly we get information and how quickly we can execute changes based on that information, might change the way these graphs look. So.
And could I ask you to do me a favor?
Yeah.
Could you erase that whiteboard?
Yeah.
Please.
Yeah.
I think this is super important for us to dwell on just a little bit and talk to our clients on. Think about where we're at. We had really high price inflation, which was a result of all the money that got dumped into the system during COVID and before, right? So the Fed is working to get their inflation numbers down to 2%, right? That's their stated goal, is 2%. Why have they been so cautious about bringing mortgage rates down? We know that every 1% change in mortgage rates is a 10% impact on buying power, which essentially is a 10% impact on price. So if you really stop and think about it, if your goal is to get inflation down, why would you want interest rates in the housing sector to come down, driving up housing prices, which then reflects in the CPI number? It's a dog chasing its tail, right? So that kind of conversation with our clients, I think, helps them understand, oh, okay, this is making more sense to me now. How are we doing? I've got a few more slides. How are we? Can we go a little bit past 12? Are we okay to do that? Yeah? Okay. So Ken's smart, very smarter. I don't claim to be God's gift to this stuff. I am very elementary on this. I've mentioned it before. Barry goes into huge depth. His brother Ken's pretty good too. If you ever want a good analysis or a good explanation of what someone thinks is going to happen or what has happened, Barry's really good about not only talking about where he thinks things are going, but going back and indicating why he was wrong, if he was wrong on his predictions. And I think that's super important because, again, it's context, right? I think the other thing that's important for us to keep in mind and always ask is the same thing I said last year, compared to what? And that's why I think Barry's so good, because he actually breaks it down and says, this is why this happened and why I was wrong. So let's look at some compared to what stuff. I'm waiting for prices to come down. Who's heard that? Okay. This is median residential prices across the US from 1965 until, I think it goes through the second quarter of 25. That's the most recent I can get. This is all on the Federal Reserve page for the St. Louis Fed. If you just type in Fred 30-year mortgage, wealth of information on there. So if we look at this curve, it's very obvious what happened right here, right? We know, we live this, we know what happened here. Gary's gonna talk about this in February. What he does is he says, all right, so if we normalize this and take a line and run it through this chart, where do we end up? We're probably about here. We don't have to go too much further into the future with this line going maybe a little bit down or sideways until it intersects again. And when that intersects, we're right on the trend line for where prices should be. This is Minnesota. We jump back. That's national. This is Minnesota. We know what happened here locally. We did not explode like it did in other markets of the country. So that's the other discussion we have to have. Real estate is global, and Minnesota reacted totally differently than a lot of markets across the country. We didn't see these we saw big gains, don't get me wrong, but we didn't see blow off top kind of gains. This, we know, is not because of our market, because our market is still doing this, right? So same thing, normalize that, draw a line through. Where are we? Maybe a little bit above, maybe intersecting. Draw it how you want, we're not that far off. Right, and it comes back to that 3%, 3%, and 3% thing. This is going to continue to go up if it doesn't. Our system is broken. Here's another thing. I did this last year. I updated it because I thought this was so good. This came from Ken's brother Barry. Median price home in the U.S. $415,000. Requires a household income of $114,000 to buy that house. Oh boy. Our median household income in this country is $87,000. And we've got a problem. We've got a huge problem. Nobody can buy the house. So we stop and think about what it is that we're comparing and measuring. If you remove those households that make $20,000 or less, median household income in this country is $103,000. I don't know about you, but I would argue a household that makes $20,000 or less is not in the whole line. If you remove households of $40,000 and under, all of a sudden we're at a median household income of $124,500. $40,000 households are not buying houses either. Just the fact of it. The last one is if you remove those making $60,000 or less. And I will argue, in our market, they're not home buyers either. They end up at $148,600 once they're removed. You need 114 to buy the house. These two are well above it. So again, think about the language that's being used. Think about the stats that are being thrown out there. And the stats can tell a story, and then they can be turned around and they can tell the exact opposite story. So what are we comparing what we're looking at to? Step back, big picture. Make sense?
Yes.
Any questions? Your version didn't have it. Believe it or not, this is from someone's phone. That's what shows up when Ken calls. Steve.
Just a little bit of a sidebar. I've been trying to watch the numbers that I record every day to see something that indicates to me that, hey, it's about to start to take off. And I've only collected a few numbers so far this morning for the raw report, but this is the first time, and I think it'll hold through the rest of the day, that the inventory for today is less than last week. And that happened several years ago, but it doesn't happen very often. Usually January through
Too cold. Nobody's listening.
September, the inventory keeps going up. So it's down, where's my chart? I think it's down, it's not a huge thing, but it's down 63 from last Wednesday. And I think it will hold somewhere around 55 or 60. So,
Something that.
so why is that? I think the pendings, I would think the pendings would show up because if if we have 700 or 800 coming in new listings every week, then there's not that many expirations or cancellations, so it's got to be pendings, right? So anyway, I just I hope it's okay. I tossed that out.
No, absolutely. No, and I think, obviously, you will watch it. I know you will. And I'm sure it's gonna be in your narrative as we get a few weeks in, if you see a trend. Jason.
Our newest agent, as of today, Marina, let's give her a quick hand.
Sorry, thank you. So what is the interest rate as of today?
As of today, where are you at, Ken?
Let's see what it looked at.
Probably.
I was looking at it in the meeting, so
Low sixes.
it fluctuates, but yeah, we had a nice rally. We're down a little bit today, but like the average conventional rate was sitting in that like 6.1 to 6.2 range. Now that's aggregated data. If anyone's ever seen the rate update videos, first time home buyer programs are included in that, or income cap programs. So going back to those income limits, if you're under a certain amount, you you have an incentivized rate to purchase a home. So some of that data is in there, but like 6.1, 6.16 range for a conventional loan, somewhere in there.
Thank you.
What else?
And I would say one more thing too, guys, just there is a magnet, like I get a lot of questions, and Brian, I'm sure you get them too, like what are rates gonna do? Like, like I have no idea. But I can tell you that there's a magnetic pull in one direction. And what do you think that magnetic pull is market-wise for rates to do? What do they want to do? They want to go up. Like, right? Because like you've got banks that are competing. You've got the free market in the mortgage world. So we have competition in the mortgage world. But something that you brought up too, and for anyone that's been in the lending world, we had these two words thrown around for a long time: margin compression, margin compression. There was a long time there where banks weren't making money. There's a lot of time there where banks were struggling on their expenses. The cost to manufacture a mortgage loan, percentage-wise, is more than it costs to manufacture a car. That's a wild thing. Percentage-wise, it is more expensive to manufacture a mortgage loan, with the regulations and all the staff that has to touch it, compliance, post-close, servicing, everything, than it is to manufacture a car. So I think there's this magnetic pull for rates to kind of do a little bit of an increase. So when you have clients that are talking about waiting for things to come down, there's just rewind the clock back any number of months in history and think, when should I have bought that home? It's always like, oh, last year, oh, the year before, oh, 5 years ago, 10 years ago, saw that in the chart. So I think it's important for us to like educating our clients on these economic indicators and on the direction that we're going. It's important.
So here's my last comment, then I'm going to be quiet. I'm sure you'll be pleased with that. If this is a chart of prices over time, right, nothing is perfect, right? We don't have a nice smooth line. We have these fluctuations. Why are there fluctuations? Well, Ken just talked about interest rates. That's one reason. One thing that was said to me last December, and I thought it was brilliant, is you might be buying at the top of the moment, but you're never buying at the top of the market. Would I rather buy here than here? Yep, I'd rather buy here than there. I'd rather buy here than there. But if I buy here and I get to here, do I really care? So you might be buying at the top of the moment, but you're not buying at the top of the moment. All right, that's all I've got.
That was pretty amazing. I don't know about you, but I don't trust the unemployment numbers because Olivia's fired me like 500 times this year already. So there's no way they can keep coming on or keep up with it.
I smell 501 coming.
Today.
Is that what that smell is? All right, so hold tight. What we Giuseppe's ready. I think it's ready. Giuseppe, isn't that just fun to say? Doesn't it sound so good? So we have Giuseppe's ready again next week. We have Ivan Ferreira, so we can focus on our jobs and how to best serve people in all communities. And then please come back in and hear from Tom and Elisa. Alicia.
Quick question.
And real quick, Tom said just a picture of him, not Alicia. Sorry. Sorry.
Actually,
Yes, question.
Alicia said that.
Towards the end, can you put that barcode for tomorrow, 2 to
Oh,
4?
look at her go. Absolutely. I promised, didn't I? Thank you. Thank you all. We appreciate you. Love you very much. Cameras, we'll keep it on.
Come back.
Just grab food, come back.
Oh, so I just started.